So right now we are starting to feel finally those long and variable lags with which monetary policy works. So the first sign of that was a Silicon Valley bank, but lots of businesses and banks are going to find this year a pretty hard, as those high interest rates are finally getting into nervous of many CEOs. So in today's episode, we'll cover the other aspects of SVB demise that we haven't yesterday, and we'll ponder about whether are there many other companies yet in this demise queue that are suggested somewhere in a media, and who might be the next entity. So I'm very glad you decided to pop in, and I hope you will find something interesting for you inside of our Blockrevision episode. And as a reminder, we are live, so if you have any questions, just put it in the chat. I will try to get this get back to this as soon as possible. Without any further ado, let's head on. All right, so at first let's find out what the first section might be, but for this one I need you to hang on. All right, so everything works fine, as I had some issues with a microphone, but if you're live, you may confirm it by writing down in the chat window in order to confirm whether everything is fine. All right, so SVB aftermath. Recently, we've seen that there are many entities being pointed out as a possible next victims of the demise, and we can find that yes, the market and central bank sector has made its homework, as those regulatory frames under which those major banks are falling for has been stricter than before 2008, and also capital and high quality assets don't appear right now to be at the root of the events leading to SVB's failure. SVB was one of the most exposed to the risk banks that has been tied to this technology sector. But as we do know, there is still some entities and even countries, as we do find right here, that are exposed to bonds that may suffer from interest rate hikes. So ECB is yet to give the guidance about quantitative tightening and further interest rates policy on its 16th March of meeting, but they wouldn't take too risky path, as they already observe what's going on in the United States, and Europe is in a majority of cases in a much more riskier ground, as Italy, for instance, has 66 billion euros of debt in government bonds, and Spain 279, France accordingly 242, and Germany 220. So if we just would get lost by this hubris and greed, and we'll print and we'll have the problems with printing money on that scale, this numbers might be even higher in the future. So what I mean is that quantitative tightening might be somewhat suitable for ECB in order to tame inflation, but as we do know, that's not that easy as it seems. So right now this boom and bust cycles are about about the greed, and banks will lose money if they fall for lending on the higher scale, and expecting that interest rate levels will remain at 0 or very low percentage points. So for now, banks only lose money on their bonds if they are forced to sell them right now, unless they won't be obliged to sell them in order to pay out deposits. Everything should work fine. But if we have another systemic risks and the sentiment get eventually lower, these bailouts might be necessary, even though it's a pejorative. I know it's a pejorative term. As according to what happened in the history, might have not other eventuality than bailing out, as that's what Fed always did, and will happen. That may happen once again, even at the expense of this inflation gauges to get worsen. For now, as we do know, we are right after CPIs for US, and that's what I want you to get. Is this inflation rate getting to 6%? So it gives us higher percentage of availability of rising by 0.25 by Fed instead of 0.5. But let's have a look at Fed probability rate. So right here, you may have that Fed probability rate right now gives us a 91%, 91.5%. But what happened right here? Is it happened to? Oh, is it has been lowered to 0%? What about? So 4.75 to 5 is the one that's the most expected. That's the one of the most expected. Yes. So the market doesn't expect the Fed to rise by 0.5%. As 1 week ago, it was at around 70% of probability rate. So right now, after those CPIs, we are almost certain that 91.5% might be so that 0.25% might be happening. So that's very interesting how that may impact the markets. But at first, let's find out what we have next in terms of the elements I wanted to cover. So a drop in TR as a harbinger of. So every time when this this yield curve has started to invert, we had a serious problems with the economy, and this time might not be other. That happened 5 times. That drop, the drop of that scale has happened at least 5 times in the past. Back then, there was a day after the largest stock market crash in history, back in 1987. In 2001, we had such drop 2 days after a what was it, 9/11 event, and in 2008, the day Lehman has failed. So does it mean that there won't be worse, as we are right after such event, and the economy might have problems, but not the stock market, as usually it has coincided with the bottoming phase out of the market? That will be very interesting to observe. And to conclude, back during the market outlook. Does this fall of SVB causing a critical risk for sector? That's a question. So over 465 billion wipeout in banks have been observed, but as we don't know, the risk of global crisis is smaller out of this banks demise than in 2008, where market capitalization of banking sector was at higher percentage point than it's in 2023. Right now, it's around 3 and 6%, where banking sector is around 1.3 trillion bucks, whereas the whole US market is around 40. So it's around, as I mentioned, around 3 to 5%. Back then, in 2008, it was over 15%. So the problems caused by banking sector was outstandingly larger. About SoftBank, so that's the company that also been exposed to VC arena right now due to the slump. Many of market participants are afraid that other asset may suffer as well. There is a growing number of speculators that also betting against many companies, but right now I don't find any cracks along other companies. So what about central banks? As we do know that these correlations recently of these correlations of rising the possibility of occurring a global financial risk and gold purchases is rising, and we do know that obviously the net purchases of gold coincide with this very turbulent times, and right now it looks like central banks has forecasted for themselves that this time might be much difficult to tackle than previous times, and this tendency of central banks buying gold started to literally skyrocket after this global financial crisis, when we would find that at first that banks are not longer reliable source of holding money. That's why I would say that central banks are literally hedging themselves from collapses and from the risk that they are literally making by themselves. So central banks causing in a short time and medium maybe a smaller volatility and have positive overall economic impact, but in the I would say over medium and long-term horizon, causing more volatility and more overall economic impact, negative that may conclude with some large economic problems, juxtaposing CPIs or inflation rate, whatever you will name it, or other bankruptcies that may have a larger impact as of larger capitalization of those companies being under water. So this is it. So right now Fed is sweeping under the carpet everything. There is a larger possibility of hiking interest rates by 0.25, especially after seeing such cracks in the economy. Whereas right now, we are still with a level of real interest rates remaining at a negative real yield, and that's why we still would need to hike for longer. Whether it's 0.5 this time, it's debatable, but this interest rate cuts won't happen this year with a high certainty. All right, so let's head on to market outlook and let's find out what about what the markets are saying right now. So in terms of SPX, right here we can find that we have tried to rebound out of this level of low boundary of this rising channel that was formed back in December and January. Sorry, I haven't turned on the right window. So SPX has started to find a bottom between this area. We don't know that in terms of Fibonacci extension that recently get us to 0.5. Right now we are at below 0.78.6, but when it comes to start of an impulse, we are right now trying to cover this 0.5 extension. That is a I would say very important level for the bulls to decide whether they are in majority, or rather the bears are starting to take over the decisive power role in that index. So for me, SPX might be somewhere within a bottoming process. We would find a type of a rebound out of this congestion area, and right after, it's very important to get over this 39.2 level in order to get back to this higher levels and possible bulls return. All right, so in terms of crypto outlook, what we have right here, so Bitcoin has been created as the one that may withstand all of this market turbulence that we are right now tackling with. So Bitcoin was made for the moment when this great reset may eventually come over, and all of these banks will have a much more doom and gloomy time than we are heading right now. So will the financial world be interested in Bitcoin as a main currency during this possible great reset, when we have the transition from a central entities to decentralized one? I do find that it's still possible in order to deliver this, but we need a still stronger awareness that that type of solutions are necessary. So I do expect that in the future we may have one day even a chance to vote for I don't know, artificial intelligence political party, and have these Boolean outcomes of our actions, and the Bitcoin might be the one digital currency that might have a unchangeable rules that are governed by, but it's still a decades from here. So right now, as we do know, Bitcoin, in order to work, doesn't need a central type of control. There might bring over a significant shift, and will it be underway? We are still we are still assessing a possibility of introducing CBDCs, but with CBDCs, we'll still have this central bank planning intact. That's why the Bitcoin might be the one of the answers, and that may be an alternative to all of this bullshit that we have been treated with. And also during this day, like here, when we have lots of headwinds, altcoins are noting outflow, especially after the institution of Halborn discovered that 0-day impacting Dogecoin and over 280 networks, including Litecoin and Zcash, putting over $25 billion of digital assets at risk. We'll have, regarding this, we'll have another argument for leaning towards a more, I would say, more stable and also more sturdy digital payment system than its Bitcoin. So 0-day exploit is the one that putting a hacked patches on updates of software, and we do know that with altcoins it's much more probable that something will be hacked, as the size of the networks that are maintaining those blockchains are not enough to stave off all of the risks. That's why I would put on Bitcoin in order to assess whether it's a good or bad solution for this difficult financial sector times. Okay, so that's it. In order to find out what's about market movers, we'll jump to economic calendar, and as we have mentioned, we already had this inflation rate, so let's find it in details. So we can find that food prices grew at a slower rate, while the cost of used cars and trucks continued to decline. Also, costs slowed sharply for energy and fuel oil, with gasoline prices falling 2% after 1.5% rise in January. So that's optimistic when looking at the economy. Many of us were expecting that after this PCE higher than expected, we may have another downturn lag caused by this merely CPI gauges. Right now, it looks like this risk has been put off. All right, so in terms of earnings calendar, let's find out quickly what's happening right here. On Monday, we had a GitLab that found positive EPS, and has noted also better than consensus reports. On Tuesday, we have Sentinel-1 and Stoneco as the one of the most, and Lennar Corporation as well, as I have skipped this one, so that it's worth watching. Whereas on Wednesday, that's very important, that is Adobe, in order to getting a possible boost for the Nasdaq to bolster these difficult times of we've been throughout a recent week. All right, so it looks like that's it, but we are still ahead of Trade Idea. So in terms of Trade Idea, that's interesting how the market behaves right after this CPI gauges. US 100 right now is trying to get out of this consolidation, and we do find it right here. We are right now trying to get out quickly out of this consolidation, and it's highly possible with such of a defendance of the market right here. So for me, US 100 might be the one that might be right now rebounding and moving much higher out of here. This defendance of this area is very very strong. That's why I expect that US 100 may head higher right from there, and I do expect that if we just if we just zoom out, the next target for US 100 is 12.33, and I do find that's the one of the target that might get achieved within next few sessions. In order to find out where is the best entrance area, for me is right around this, right within this rectangle, and that's the one that is limited by 11.97 and 12.03. So right here, it's risk-reward ratio at 2.72, and in my view, it's still a decent one. So yeah, US 100 is building power for the rebound, and it may take us a few sessions to get to 12.3033. So all right, so in this episode that's everything. Thank you very much for watching. If you have any questions, just put it in comments below the video, and we are seeing each other tomorrow at 8:45 a.m. East time.